It's Wednesday, May 22nd. Welcome to Market Foolery. I'm Chris Hill. Joining me in studio today from Motley Fool Supernova, Matt Argersinger, and from Fool.com, Matt Koppenheffer. Thanks for being here, guys.
Hey,
howdy, Chris.
It's a short week for us because we've got the Memorial Day weekend coming up here in the States. So this is it for this week. We will be back next week. Enjoy the long weekend, everyone. Today we're going to talk Wall Street banks and a little bit of trouble in the Magic Kingdom. But let's start with the Fed chief. Ben Bernanke went to Congress today. He's still there now because it's Congress, and when you're testifying in front of the Joint Economic Committee, it's going to be a long day for you. But the headline, guys, is that Bernanke said the U.S. job market is still weak and that it's too soon for the Fed to end the stimulus program. So, Matt Koppenheffer, I'll just start with you. Any rumors or any thinking that the free money forever program was going to end and that Bernanke was going to telegraph that's off the table now?
I think so. And, you know, I'll be perfectly clear on this. I think this is kind of an unpopular thing to say, but I think he's right. I think that's the bottom line. You look at the indicators. The economy is starting to improve. We've seen some GDP growth. We've seen some employment growth, but it's not growing very fast. We're not seeing much in terms of price inflation. We're not seeing stretching capacity. So, you know, Bernanke is basically fighting against Congress. You know, if you're cooking in the kitchen and you're trying to make something delicious and somebody is coming in and putting dirt in your soup, that's sort of like what Congress is doing to Bernanke.
That's bad.
It is bad. It doesn't make for a tasty stew. But I think that he's got little choice except to keep accommodation in place for now.
You agree with this?
Well, yes, except I worry that he's fighting something bigger. I mean, I know one of the mandates of the Fed is, unemployment. The problem is I feel like we're down at 7.5% unemployment right now. And I just feel like we might be at a point where there's a structural problem with the U.S. economy. And that is we don't have enough jobs for the low-skilled workers, enough jobs for those low-skilled workers that's actually going to really dramatically bring down the rate. I mean, and that's why, there's all this pressure to pass this new immigration bill. You got executives from Silicon Valley saying, hey, we're hiring. We're hiring thousands of people. We just can't find enough. And we can't find enough programmers. We can't find enough systems analysts, network specialists. So I'm worried that the Fed's on this, train, this ever faster moving train, trying to get to this some mythical 6%, I guess, unemployment rate, which is their target. They might not ever get there. And then at that point, what's the end game if that is the conclusion? That's kind of what I'm worried about.
Yeah, that does seem the 6%, while great in theory, I just look at that and think, boy, is that
really full employment today? Well, in the new normal? I hate using that phrase.
Is that really full employment, or is that sort of a stretch target? And if we actually get it down sustainably under 7% and it's 6.8, 6.7, that sort of thing, then the conversation can be had about moving it, saying, we're close enough. I don't know, but Matt, we were talking earlier this morning. If you're a Wall Street bank, this is music to your ears, isn't it? The free money forever.
It at least puts the pain off for a little bit longer. This won't continue for forever, and when it does change, it'll eventually be better news for banks. Not necessarily just the Wall Street banks. I mean, banks across the U.S. because essentially right now, when they're trying to lend money out, they're getting very little return for it. When the policy changes, when rates start rising, the quicker to change funding costs that these banks face will rise faster than the assets that they're holding, and that'll be bad news for their bottom line. As we look out longer term, though, they'll be able to lend at higher rates. Eventually, we'll see the interest spreads start to expand again for the banks. But in the short term, it'll be bad news for them. So right now, with Bernanke saying keeping money cheap, it'll be good for the banks at least for the next couple of years.
We had talked recently about the market hitting a new high. It's seemingly every other week, and to the extent that something like that on a large scale affects your investment approach. Does this affect your investment approach? Monetary policy in the U.S., does it matter to you? Is it at all a factor, or is it just something that is sort of on the back burner for you as an investor, and instead you look at it as if there's some radical shift, then maybe it's going to change my investing approach, but otherwise, no, I don't take this into account.
Well, for me, it doesn't. I mean, I'm looking at the Fed. I want to understand what's going on there. I want to understand the impacts that it has. But even in terms of banks, which are going to be some of the most affected institutions from the Fed's policy, I'm looking at who's running the bank. I'm looking at the value of the franchise, how they're operating, and trying to guess what Bernanke is going to do. Whether I think he's right or not is not a winner's game.
I am paying attention because even Buffett himself said it will be the shot heard around the world when the Fed sort of steps back off the gas pedal. And so just my only perspective is when that happens, I think there's likely going to be a market correction. Your banks will probably sell off especially, and so there are going to be opportunities. And so you just want to be ready to take advantage.
Is this a situation where companies that have more cash on the balance sheet are going to be in much better shape than companies that don't?
Well, companies that have more cash on the balance sheet are always better off.
Yeah, I was going to say. As soon as I said that, I thought, well, you know what? All things being equal, you probably want to be a company with a lot of cash on the balance sheet.
But I think especially looking at financials, looking at banks or insurance companies, for example, which are better capitalized, they're going to be able to take advantage of higher rates, as Matt was talking about in the long term, and in that's a good thing. So look for those well-capitalized banks, and those might be ones you'd look at as opportunities.
Speaking of banks, J.P. Morgan Chase CEO Jamie Dimon has been under fire lately. There have been increased calls for him to separate the jobs of CEO and chairman of the board, both of which he holds. And there was a vote held yesterday, Matt Koppenheffer, and it was a landslide. He easily survived the vote. First and foremost, did that surprise you at all?
It didn't surprise me. I kind of saw this coming. I didn't see it to that extent. So last year they had a similar there was a similar shareholder vote on the table, and there were 40% of shareholders that voted in favor of it. There were only 32% this year, and it was there was much more of a push, much more of a media outcry this year to get Dimon to split up the roles. I think the right thing happened here. I think it was kind of a little sad, a little interesting to see Jamie Dimon sort of reveal a little bit of that weak ego in saying, I hate you guys. I'm going to take my ball and go home if you take away my chairmanship.
Yeah, he basically said, if you do this, I'm out of here. I'm stepping down. And most people give him high marks for the job he has done as CEO. Even when you factor in the whole London whale incident, he gets high marks going back to the 2008 crisis and sort of how things were handled out of that.
Well, it's been such a turnaround. Coming out of the credit crisis, everybody was saying, Jamie Dimon, he's the best banker ever. I mean, we couldn't even imagine a better banker than Jamie Dimon. And then the London whale happened, and all of a sudden it's like, if he leaves J.P. Morgan, maybe that's even a positive for J.P. Morgan. I find myself somewhere in the middle. I think he's a good banker. I don't think he's the best. He may not even be great. He's a good banker, and I think he'll do well for J.P. Morgan shareholders going forward.
He's done well in the sense that J.P. Morgan has outperformed all the other big banks except for Wells Fargo, right. I think, since the crisis. But, I don't know. I mean, J.P. Morgan, he took over, I think, the CEO role in 2005 and then the chairman role in 2006. J.P. Morgan's underperformed the market since then. Granted, we had a big financial crisis that hit banks a lot harder. At the same time, I'm certainly not a person who puts Jamie Dimon on a pedestal. I think he's had a lot of influence on the Fed, being on the board. And certainly with J.P. Morgan's outperformance of the other banks, he's treated at a higher stage. But he was also paid $23 million in 2011, which was by far bigger than any other banker. And I think I look at his threat as a little childish. I mean, I think a lot of shareholders said, "Gosh, if Jamie Dimon leaves, J.P. Morgan stock's going to drop 15%. I don't want to take that hit. I'd rather just keep him in the role." And that's kind of the reason he won handily.
I read one essay that our colleague down at Motley Asset Management, Tim Hansen, had tweeted out, I think it was last week, where someone was making the case for splitting up the CEO and chairmanship. And the crux of his argument with respect to Dimon was he should split this up because he has done a terrible job being chairman, because one of the primary jobs of the chairman of the board is to plan for succession for the CEO. And he has done none of that. With that in mind, stepping back from J.P. Morgan Chase, as a general rule of thumb, do you prefer to see two different people in those roles? Does it not matter to you? Do you give an exception to people that you feel like do it well? I'm, as we're having this conversation, I'm running through in my head the stocks that I own, and I'm trying to think of, well, now wait a minute. Who is the, are there people who are separate CEO and chairman at all of these companies? And off the top of my head, I'm not entirely sure. So clearly it's not a major factor for me, but that argument resonates with me. The whole notion of, look, if you're the chairman of the board, one of your primary responsibilities is to plan for what happens if this CEO, who hopefully is doing a good job, gets hit by a bus. And in that regard, I feel like they should be two separate. But what do you think, Matt?
Well, right, and you see, obviously, Buffett's been chairman and CEO of Berkshire Hathaway forever, and he's of course especially over the last few years.
And that's worked out well.
It's worked out pretty well, And other examples. I mean, I think I'm pretty sure Jeff Bezos is also the chairman and CEO of Amazon, for example. There are great examples of CEOs who have taken the dual role. As long as they've built a culture where there's a certain amount of objectivity, the chairman sort of allows the board to do its job, and he or she doesn't invite him or herself to those meetings, lets the board kind of do their thing and not wield as much influence in that chairmanship role. So, gosh, it's a situational thing, I think. And I'm not sure how it should apply. I mean, Wells Fargo, Stumpf is also the chairman and CEO of Wells Fargo, and that's obviously worked out pretty well.
And the same is true at Goldman Sachs as well. And in some cases, it works out very poorly. Aubrey McClendon was chairman and CEO.
I was just going to say,
there you go.
At Chesapeake for a long time, and that wasn't a tremendously good situation.
Before we get to our final story, two quick things. As I mentioned earlier in the week, we have a special free report. It's our top stock. You can get the report just by emailing us, topstock2013@fool.com. That email address again is topstock2013@fool.com. It was written up by Andy Cross, our chief investment officer. I actually read the report, and it's a company I'd never heard of before, but one, after reading the report, I definitely added to my watch list. So, again, it's a free report. Just email us, topstock2013@fool.com.
Writing that down.
The other thing I wanted to mention was, I don't know about you, Matt Argersinger, I had a somewhat relaxing weekend. Did you as well?
Moderately.
But Matt Koppenheffer, I know for a fact you did not have a relaxing weekend because you ran a 100-mile race.
I did.
This is your first 100-mile race.
That is correct. Relaxing is not the way to describe it.
It's not, yeah. So it was your first one. More than 200 people entered the race. You came in ninth, which is amazing. So kudos for that.
Oh,
but
wow.
just if you could spend 20 or 30 seconds just for our dozens of listeners, what was it like to run a 100-mile race over a 24-hour period?
Well, by the end of it, it felt very much like just going up a mountain and then stumbling back down a mountain. It was in the George Washington National Forest. It was the Massanutten Mountain Trail 100, and it is a rocky course, and there are boulders and stones everywhere that I unfortunately left a lot of blood on. It was
my gosh,
it was a trying experience, but it was a lot of fun. And I have to give a shout out to my crew. I had a great crew. My family was there. My wife was there. They did a fantastic job making sure that I did not end up face down somewhere on that course.
And what was your final time? It was 23 hours?
23 hours, 9 minutes.
And at what point in the race did you come closest to thinking, I've made a terrible mistake?
Actually,
in the words of Ron Burgundy, I immediately regret this decision.
Mile 20.
Mile 20?
Mile 20. Yep, with 80 miles
miles
left to go.
1/5 of the way through.
Yeah.
And
but it changes. That's the amazing thing about a 100-mile race. At mile 20, you can feel like I have made a terrible mistake. What have I done here? And then by mile 25, I was like, this is the greatest thing I've ever done.
I don't know why I just thought of this, but 1990s. There's this movie called Seven, which is bear with me on this. Brad Pitt's chasing down Kevin Spacey, I think, who's this serial killer.
Morgan Freeman is the cop who's getting ready to retire, and Brad Pitt's his partner.
If you're about to compare me to a psychotic serial killer.
Well, so there's one point in the movie where after they capture Kevin Spacey, where Brad Pitt turns around in the car and says, "Now, when you're crazy, do you actually know that you're crazy?" And I'm just, I want to know if you're running a 100-mile race, do you ever point and say, "God, Who does this? I mean, 0.0001% of the population would even fathom doing something like this. And here I am. I'm doing it.
Well, see, that's the thing about crazy people. They don't know it.
There you go. So
good to know. When it seems like whenever we talk about Disney, most times it comes up that ESPN is a cash cow for Disney. But it turns out that even ESPN is not immune to the rising cost of content, because there are reports now that ESPN is laying off somewhere between 300 and 400 employees. Maddie, that's upwards of 6% of their staff.
Mm-hmm.
I don't know about you. I was surprised when I saw this news because, again, ESPN just seemingly prints money for Disney.
It's the workhorse. Yeah, this was surprising to me. You know, we talk a lot about content, cost of content when we talk about movies and TV shows, but gosh, it's nothing when you talk about sports. I mean, I'm looking at the $1.9 billion that ESPN pays every year to the NFL just for Monday Night Football. $1.9 billion. I mean, and they broadcast, 14 of those games? So that's more than $100 million per game.
Yeah.
That's incredible. And then, of course, they're paying $700 million per year to baseball. That's a new 8-year deal they signed last year. That was double what they were paying before that. And then, of course, we know that they just signed this 20-year deal with the SEC.
And they're launching an SEC network.
So these are not, and they have the NBA and other things. And this is not cheap. And so, as much as we are impressed with ESPN and its earnings power, man, at some point, the content costs catch up, and I'm sure it's caught up a little bit right now.
Again, I was caught off guard by this story. I was surprised that, again, that ESPN would lay people off given how profitable it is. And the more I read about this, the more I find myself wondering, to what extent is this gravy train ending? Maybe not anytime soon, but I don't think anyone looks at the cost of live sports programming and thinks to themselves, oh, that's going to come down over time.
No, especially, and also there's more competition. You got NBC, which just launched their 24-hour sports network, and I've heard News Corp is launching a Fox 24-hour sports network. So there are going to be more buyers in this market at some point. And so, gosh, yeah, I certainly see the content costs going up over time.
At any point, do you think that there's going to be televised coverage of 100-mile races, and then we'll see our man Matt Koppenheffer running in them?
I think there's a greater chance that there'd be 24-hour cycles of the movie Seven, recurring on some channel. But
I will say, if they're worried about the cost of sporting events, they could probably secure the rights for $100, $200 for one of these events.
For one of those races.
A couple $100 and you got it.
Matt's looking for sponsors, so send him an email.
Exactly.
Matt Koppenheffer, Matt Argersinger, guys, thanks for being here.
Thanks, Chris.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. That's it for this edition of Market Foolery. Our producer is Matt Greer. I'm Chris Hill. Thanks for listening. We're off tomorrow. We will be back next Tuesday. Enjoy the long weekend.